All right, welcome back, everybody. And this is your weekly mortgage education course. Black Diamond is doing a weekly course all the way from the first of the year through April. And so each week we're going to cover topics that are intended ultimately to help you be, if you're a real estate agent, help your clients better. If you're a consumer, hopefully teach you some things that will help you navigate the mortgage world, which, unless you're in it, can be kind of daunting. And ultimately, we believe that the educated borrower or the educated person is going to end up winning in the long run. And so our goal really is to make sure that everybody knows as much as they can about the mortgage process. So I'm Zach Falk. I'm a loan officer here at Black Diamond. If you don't know me, I've been here for a few years and I love mortgages. I describe myself as having not worked in mortgages for a while. And then when I did, it was as though it was a puzzle piece that had been missing from my personal puzzle that was, clicked into place. Super cliche, super cheesy, but that's honestly how I feel about the mortgage industry. So pleasure to be with you this morning. Today, we're going to talk about asset-based lending tools and tips. Asset-based lending is a term that kind of gets thrown around a lot, and I don't know that everybody actually knows how it works. So we're going to try and dispel some of the myths that exist for you today. I do really like questions from the audience. I think that helps me kind of hone in on what you actually want to know. So if you have a question, you can stop me at any time. I think that everybody learns more effectively if we're dealing with the things that you want to know rather than the things I think you want to know. If you don't stop me, I will just ramble on too. So that's the other danger. We're going to do some exercises. So if you have access to pen and paper, I can pass out some paper here for you guys. And then a calculator, that would be helpful. I'm going to teach you kind of some of how asset lending calculations are done. So if you can grab those now, that would be great. I should have grabbed some for you guys here, but Dave's on it. Thank you, Dave. So this is, of course, a class about asset lending, but the one caveat to everything is I joke with people and I say, I sell debt for a living. That's what I do as a mortgage loan officer. However, my objective in the long term is always to get you out of debt. So hey Ty, welcome. So the best form of asset lending, so to speak, is actually cash. And that's kind of counterintuitive because it doesn't involve any lending at all, but it is an asset. And if you can buy a property with cash, it's still a good idea to talk to a financial advisor or talk to a mortgage expert, but 9 out of 10 times you should use that asset and avoid the mortgage process altogether. Secondarily, if you don't have cash, the next best form of financing is always going to be conventional or government mortgages. And so again, it's kind of counterintuitive to what we're talking about. But the reason I mention that is that whenever you're getting into something like asset-based lending, you want to make sure you're working with somebody who understands the whole picture. At Black Diamond, we're going to make sure that we start with the best possible loan product and then kind of work backward from there. The end goal is always a house. We want to get a consumer a home. We want to put keys in the hands of people, but we want to do that in the most cost-effective way. So my point is if you can do other options, you might want to consider that. Just recognize that. Asset-based lending is oftentimes considered non-QM financing. There's some asset-based lending that actually is within the conventional world of financing. We'll talk about that later. But a large percentage of it is called non-QM financing. So quick understanding of what that is. Most people, when they think mortgages, they think conventional, FHA, RD, VA, right? Those are the normal loan products that you hear all the time. Those are sold on the secondary market. They're either government backed or they're backed by the big dogs, Fannie Mae and Freddie Mac. Non-QM is a separate sector of mortgage financing where you essentially have a pool of investors lending money out to people that don't fit the mold of the conventional FHA, VA, RD financing world. So a couple examples of that would be that we see all the time in Montana are someone who's self-employed. Maybe they're 2 years in, they're absolutely crushing it, but they've been writing a lot of business revenue off because they are still building their business. It's really common for them to still want to buy a house because they're doing great. And why would you not want to buy a house? So that would be an example of where maybe a non-QM loan, like a bank statement loan, would come in and actually solve the issue. So non-QM is designed to help people who can't get, quote, normal loans. And so that's sort of what asset-based lending ends up falling into. And we'll get into that a little more specifically here in a moment. So the first question that we really want to talk about is when would you use asset-based lending? We just talked about a lot of reasons not to use it. So when would you use it? Well, there's a couple possibilities. There's about 4 from what I can gather. One is that conventional and government loans work, but not quite. And that might be where you use some asset-based lending to support a normal loan application. We'll get to that in a moment. Number 2, conventional government loans just don't quite work, but it's by more than barely, meaning everything's based on the ability to repay. So the debt to income ratio, you guys hear that term a lot. Lenders are always looking at the debt to income ratio. So if the debt to income ratio is way out of scope, then you might have to do some more creative asset-based lending than if it were just slightly out of scope. Option 3 would be that conventional government loans don't work at all, and you have to go with something asset-based entirely. That would be a time that you would consider one of the products we're going to talk about. And then option 4 is this, and this one happens kind of depending on economic factors. Let's say you have a consumer who has significant cash and they don't actually need a mortgage, but they want one. And there's a couple of reasons why somebody might actually want a mortgage, and we'll get into that later as well. So, as a real estate agent, I'll talk to realtors here for a moment. What you want to do is you want to start figuring out if your buyer, if you're on the buying side, this is really where this applies, which category of these 4 they're going to fit into. You're always trying to learn things about them, right? What are their strengths? But you can ask super simple questions, honestly, that really help get down to ultimately helping them get to where they need to be, which number 1 is, are you talking to a mortgage expert, right? Because the mortgage guy can absolutely help get things taken care of. But you want to try and figure out your borrower's lending capacity early in the process. And you can do that through normal conversation. You can basically just ask them if they plan to pay cash or if they plan to get a mortgage. That's a pretty normal question that you're going to ask every consumer. Then you can ask them, well, what amount of down payment are you planning on using for this house? Again, very normal question you're going to ask every consumer. If they start to go, well, I'm planning on dropping $200,000, $300,000, $400,000 on this $600,000 home, that's something you need to know. And then all of a sudden you're in a different conversation. You're like, okay, so this is somebody who has cash. Do I need to be aware of potential asset-based options? And so what you're doing is you're basically just kind of building a understanding of your client that's going to help you help them once they go through the mortgage process. You can encourage them to do certain things. I just threw this in here because this is different. You guys are kind of asking maybe some more generic questions of the consumer. When they come over to the mortgage office, I once heard a mortgage or a loan officer describe their job like this. They said, my job is to ask my clients to get financially naked so I can judge whether they look good enough or not. Like, how about that, right? Just think about that as an analogy. And it's true, and it can be uncomfortable for people. And that's why a lot of people don't want to do it, is it gets weird. Just know that we don't actually judge people. So it's okay. We help people create confidence in their physique. Okay, so let's get into some more of the specifics. The asset-based lending calculation oftentimes starts with a term called asset depletion. And I'm guessing that a lot of you have heard that term because that's the most common one that gets thrown around when we talk about asset-based lending. So asset depletion, just to help you understand the way that it's calculated, is you take the total number of eligible net assets for the borrower. Eligible is an important word. Net is an important word. We'll get into that in a moment. And then you divide them by the term of the loan in months, not in years. If you divide by years, you will get the wrong math. And then that is going to produce a monthly income. So again, this is not something you need to necessarily know all the specifics on, but it helps you understand what a mortgage loan officer is going to do if they're in this category. So eligible assets, let's talk a minute about that. Generally, those include things like retirement accounts. You have investment accounts that are generally acceptable. Of course, savings and checking, those are all fine. Some stock portfolios are okay. Basically, anything that you think of as a normal monetary financial asset is something that we can at least consider. We were joking before we got started that you probably can't use cattle, right, as an opportunity to create an eligible asset for asset depletion. The next important term that I mentioned is net. So if you think about your income, if you're a W-2 employee. Most of you are probably not, since we're in a commission-based industry, but bear with me. You have a gross pay, which is what your employer gives you, but then that's not necessarily what you take home. Taxes come out, Social Security comes out, Medicare comes out, or whatever it is. And that produces a net amount that you bring home to your family, right? So the same concept is true with assets specific to asset-based lending. If you have a 401k that you want to use for asset depletion to add money to a loan application and therefore get you approved, then you probably have to know what the penalties associated with that 401k withdrawal process are. So that's an important one. So oftentimes, if we're talking asset-based lending, I'm going to ask people to provide terms of withdrawal to our office so we can understand what that net number is. The most common amount is 10%. So if you keep that in mind, so if somebody has $1 million in a 401k, generally speaking, there's at least a 10% haircut for fees related to withdrawal, which means they have a net amount of $900,000. See how that math works. So that's important. So all this matters because it's producing amount of monthly income that a mortgage originator is going to add to the loan application to get your borrower approved. So to make it a little bit more tangible, let's do an actual example. So this is where it'd be nice if you guys had calculators so you can kind of figure this out and kind of learn how it goes yourself. So in our example today, we have a consumer buying a $500,000 house, and they're getting a 30-year loan. Okay. So they have $200,000 in assets. They want to do 20% down. There are $10,000 in closing costs. Our loans are not that expensive, just so you know. That's just a way to make the numbers round. And now we need to figure out how much we can add to the loan application from asset depletion. I want to see if you guys can do this. I gave you all the information that you need. See if you can calculate it. Anybody online is welcome to jump in and say, yep, I've got it. What you should end up with is a monthly number. And it's maybe not as big as you might think. I think the other mortgage professional in the room has the correct answer. Hit the button. Chime in. Does anyone who's not in the mortgage industry want to offer up an answer? It's okay. It's scary. Dave, what'd you get? $250 a month. Dave says he got $250 a month. Bingo. Dave Boy is correct. He'll get a gold star later. Let's walk through the math. So Dave got $250 a month. So how did he do that? So first of all, we know that they are doing a 20% down payment, and it's a $500,000 house. That means that of their $200,000, they're consuming $100,000, right? That's $100,000 that we can no longer deplete because it will be spent at closing. $10,000 in closing costs, same thing. It's an amount of money that will be spent at closing. So it's gone. It's being consumed. So the total amount that we have left over is $90,000. Then I told you that he was taking a 30-year loan. So that's 360 months. So the math is $90,000 divided by 360 months. Does that make sense? So that gets you to $250 a month that adds to the loan application. So in that example, you might go $250 a month. That doesn't really seem like it does a whole lot to help this borrower. Well, you'd be surprised. There are times where $250 is make or break on whether somebody gets a loan. And so it's part of the loan officer's job to know about this so that, yeah, $20,000 more on the purchase price, as Dave just did the math for me. So that could be a big deal, right? So that's why you need somebody who knows what they're doing to make sure that all the boxes are checked. Okay, so I talked about ATR, ability to repay. All lenders are looking at that when they analyze the DTI, unless you're in the non-QM space. And so the math that we just did together with the term of the loan being the depletion calculation is the most conservative form of asset depletion that exists. This is where we get to the good stuff. Because non-QM lenders, talked about the difference between non-QM and conventional and government, they have a much less strict view on ATR, ability to repay, and on the debt to income ratio. The reason they do that is they make decisions to lend to consumers based on factors that maybe aren't normal. Maybe they don't have the most perfect income, but they still like the loan because there's good collateral, there's a good down payment percentage, there's a good credit score. There's a lot of reasons for somebody to still like a loan other than just income. However, most of the time, income is the lens that people look through. So because non-QM lenders are less strict, they can change that asset depletion amount. So we use the term of the loan on conventional loans, 360 months, if you're doing a 30-year loan. We have some non-QM lenders that will go all the way down to a 60-month depletion calculation. So instead of dividing that $90,000 that we just calculated by 360, divide it by 60. It's a big difference in the numbers. So let's go ahead and do that real quick together. So 90,000, we already calculated that, divided by 60. So that adds $1,500 a month to the mortgage loan application. That's a pretty big deal. If they're retired, they could set up a distribution schedule. Yes. Yep. Exactly. Because then you are basically taking the actual amount of money received into the borrower's account rather than having to deplete it over the course of time. So let's go ahead and do another example together. And this is just so that you can help learn how this goes. So this time our borrower has $2 million in assets. Okay. They're still buying a $500,000 house. Wonder why they would do that. They have 2 million in assets, right? They're still doing $100,000 down. And this time they're getting a 10-year loan, which exists. We did a lot of those in 2021, believe it or not. Interest rates in the 1% range in 2021 for 10-year loans. Whew. All right, who's got it? Everybody's ripping through.
What's the method that we're using?
This time we are staying with the conventional asset depletion calculation. We're going to do some non-QM examples shortly.
Is there closing costs?
Same closing costs, 10,000. Good question.
Have I messed up your answer?
No. No, I do math for a living. So if I mess that up, that's on me. Does anybody, Ben, can you play the Jeopardy song for us while we calculate this? No. Just kidding. Okay, let's do it together. 2 million in the bank. They have $100,000 down payment, $10,000 in closing costs. That's consumed funds. So they have a remainder of 1.89 million in their assets, right? They're getting a 10-year loan. So it's 120 months. We're doing the conventional calculation. And that math, I did it correctly, works out to be $15,750 a month in income. That is absolutely enough money to get a mortgage done. So this is where hopefully you're starting to see that there's different uses for this. And one of them, honestly, is somebody who has a lot of wealth. Wealthy people, the most common category, are at the end of their careers. They've worked hard. They've built up a lot of reserve funds. They have stock portfolios. They have retirement accounts, but they don't have what normal lenders look for with ability to repay because they don't have a normal job. So this gets us into the meat and potatoes of this, where the most advantaged category of people to take advantage of asset-based lending is someone who's retired in more cases than not. So basically then you're just figuring out the net amount. So they probably have some form of penalty if they pull that money. We just did one not long ago for a gentleman, and it worked out great. He had plenty of money, and the reason that he was actually very similar to this example. This is not his example, of course, but it's similar. He could buy the home with cash. And I actually got to the point where I had a good enough relationship with him I just asked him, I'm like, so I think it's my fiduciary responsibility to look out for you. Why aren't you buying this house with cash? Seems like it makes more sense. And he went into this elaborate scheme of why he's not buying it with cash, which I appreciated because it taught me a lot about the way some people think. He said, well, here's the deal. And this was back in 2021. He said, the yield on my stock portfolio is way higher than the interest rate that I would take on this non-QM asset-based loan. So to him, the math is very, very simple. He is seeing that he is going to make more money if he keeps his money in the stock market than if he sinks it all into a house. Brilliant, right? And so that was a lot easier to do in 21 when stocks were doing good and mortgage rates were really low, right? It's a little trickier now, but yeah, they're doing great. Everything's great. But the other thing that comes with that is that you can still make that work today, and somebody might be interested in doing that. So there's a couple other examples where that might come up. I talked to a guy just a few weeks ago who has a vesting schedule. This is another example of a client you might come in contact with. He owns stock in his company, and if he wants to, it's vested, he owns it. If he wants to get access to it, the amount of tax that he would pay the IRS is insurmountable because he was buying approximately a $1.5 million property. So he'd have to pull $1.5 million out of his vested stock and pay tax on it all in 1 year. The thought of doing that to him was like sickening because of the tax amount that it would produce. So in that example, it was actually better for him to do a small down payment, take a mortgage, and slowly retrieve his stock from his employer or from the company that he owns. So that's more of a current example where maybe the stock market's not yielding as much as people want, but there are still other examples of where this principle of asset-based lending can actually be very, very valuable. So let's see. So what I learned through that is that oftentimes people who are interested in asset-based lending are relatively intelligent people. They're thinkers. They're thinking about this. And so that's another thing you can kind of deduce when you're talking with clients is just, are they money people or are they not? And that's honestly a big way to figure out what category they're going to be in. So just a couple other specifics. We talked about the 60-month calculation. And here's a good example of where a non-QM 60-month loan or asset depletion loan makes a lot of sense. So we had a client who had a W-2 job and monthly income is not enough to make the DTI work. So the debt to income ratio was greater than 55%, which if you talk to basically anyone, no one's going to give that person a loan. So this investor that we used basically added their assets, depleted them over 60 months, and increased the monthly income enough to get their debt ratio under 50% and close the loan. So we talked just about kind of the retirement wealthy category, but this does also absolutely apply in the day-to-day workers who have done a good job of saving money and might want to push their limits to be able to get the house that they need to put their family in. Maybe they're a growing family and they have to make that choice. Well, this is a good way to try and this is super important right now. If you think about Whitefish and Columbia Falls and Kalispell and Big Fork, homes are expensive. And so oftentimes borrowers need a little boost to be able to get their approval into a position to where they can actually buy something that's suitable for their family. So I think that's really important to consider is that if you can solve that with assets, absolutely be asking the question, have you talked to your mortgage lender about asset depletion? Have you talked to them about, just make sure that they've done all their due diligence. So we're going to go ahead and use, we already did that example, so that's good. And then the only other thing that I think is important on the non-QM side is that you do have to be careful, and this is just important for you to know, is that interest rates are about 1 point to 1.5 points higher on non-QM as opposed to conventional. So that shouldn't scare anybody because the end goal is to get keys into a consumer to give them a house. So if you can do that through non-QM financing, there's no reason not to. They'll get a chance to readjust things in the future. But it basically is important because it comes into the math that we do on the mortgage side, is that if it doesn't make sense for that reason, then we'll wave the white flag and say, here's why. But just something to be aware of. So The other category of asset-based lending that we'll hit before we close is kind of the really exciting category, which is there's a lot of ways to do asset-based lending where you don't even include employment or income on the loan application at all. So in most loan application scenarios, people come to the mortgage office and they say, here's my pay stub, right? Here's my W-2 for the last year. Well, what if they don't have that? Well, there's still ways you can get loans done, and asset-based lending is a big area where we can do that. We talked a lot about the depletion method. If in that example where the individual had $2 million in assets and it produced over 15,000 a month, if that's enough, then that's the end of the story. We will leave employment off, we'll leave income off. The reason that that's beneficial is it basically makes the underwriting process a lot easier. So your client has a better mortgage experience because they're providing less paperwork. And then the opportunity for an early closing actually increases as well. So it's worth considering. The second option that you can do this where you omit employment and income is kind of fun. If your client has 125% of the total purchase price after all funds have been spent in their bank, they get the loan. Does that make sense? So if they have 125% of the purchase price, so if it was 500,000, if they had 600 grand in the bank, after the expenditures of closing costs and down payment, then there's really no work for us to do on the lending side. The loan is granted. And that's really cool because it makes everything way simpler. Now, it requires a wealthy borrower and it requires somebody who has assets, absolutely. But as an example, that might be even easier than the asset depletion route that we've been talking about. And so we'll look at that. We're always going to go from easiest to most difficult because everybody likes to be in the easy category. And then the last option is we did this for somebody in 2023. Another reason why you might not want employment or income on the loan application is because there is none. And the most common example that we saw last year was somebody moving to the area and they left jobs in another state, but they didn't really want to get jobs lined up in Montana right away. They actually preferred to get housing lined up and then go get jobs and kind of just take the relaxed approach. That's fine. There's maybe it makes sense to have a job lined up if you're moving states, but that's okay. Maybe you just want to relax and whatnot. And you find your dream house while you're in that process. So if you have 20% of the purchase price in your bank account, then there's a loan program that exists where you can actually still buy that house without disclosing that you're currently unemployed. So we did actually a few of those last year that were kind of cool. The only caveat is that the program's currently being revamped. So it's not actually immediately available, but it should be within the next month or so. So don't let that discourage you. It's just in case you call me tomorrow. And I'm like, well, we got to plan this out correctly. But it's a really cool way to use asset depletion. So just last particulars, almost all these loans require good credit. So 680 plus is generally needed for these loans. You almost always need 2 months worth of just clean asset statements. These are intended for primary, sometimes secondary residence homes. Not all that common in the investment space, but we can look at it for you because in the world of non-QM, basically anything exists. And then the last thing on the requirements is a lot of these require reserve funds. Dave talked about this last week in our jumbo class. When you get into unique financing, the way a lender offsets the risk is they want you to have money in the bank in case you need to pay your mortgage. So just consider that there's almost always 6 months required, and reserves is basically just the number of mortgage payments multiplied by months. So like if you need 6 months reserves, it's whatever the mortgage payment is times 6. They need that amount in their bank account after closing. Normally not an issue for people that are in this category and interested in asset-based lending, but it is something to just pay attention to. So that was a lot of very specific information on how we look at asset depletion. Hopefully it was valuable information for you. Before we go, I do want to make sure that we have all questions answered. So if anybody here live or if anybody online has a question, hit me with it now. Thanks. Good. Good. Somebody said it made sense, and that's
I'll have a cool
amazing.
if you answer all the questions.
Yeah, Dave has a tip.
That last one you mentioned where they only have to have the down payment, that comes from the CDFI. Do you want to tell people what it is?
Yes. So
Because it's a political election year.
yeah, yeah. Do you want to get into that?
Just summarize it.
So the last loan I mentioned where you need 20% down, no employment, no income goes on the loan application. The money for that loan program comes from the CDFI, which is a community development fund. And so the irony of it is just that it's designed for helping people get loans that otherwise couldn't. The irony is that you need the 20% down. And so conceptually it's pretty cool, but it's basically, it's a political sort of agenda. It's for disadvantaged communities. It's, anyway, Dave thought it was relevant because it's an election year. So yes. Congressmen and women like that loan program. So let's do a bunch of loans in 24 that use that loan program, right? Last opportunity for questions. Okay. Well, I'll close with this. The loan hotline at Black Diamond Mortgage is always on 24/7. So you can call 406-862-4999. You can actually text that as well, and we'll get back to you if that's more convenient for you. We like to help on basically every loan file. So if you're stuck somewhere with a lender that is doing something that you're not sure is correct, or you're confused, but you don't want to call them because whatever reason, call us. We care about helping people get homes, and that doesn't matter if we're not the lender on there. Do we want to be that? Sure. But we want to help more than anything. So feel free to call us just for advice, or if you want to get a second opinion on something at any time. Next week, our topic is VA loans of unlimited size. So you don't want to miss that one. Next week, Wednesday, 10 a.m. here at the office or online. Don't miss it. Have a good day. See you guys.
Oh, wait, I had a question.